KC. The stock has had ups and downs recently, but it still carries a 4% yield, and it's gotten a recent bounce on additional analyst coverage. So I think now is a good time to buy. And if you want to invest in Turkey but are uncomfortable buying specific stocks, take a look at the iShares. It offers an ETF that you might want to consider. That ETF focuses heavily on the Turkish banking sector, which makes up more than 50% of its holdings. But it also owns shares in telecom, like the Turkcell, industrial materials, and consumer goods companies as well.
Okay. We've gotten your picks now. Let's head over to some of your pans. What are you seeing in these emerging economies?
Well, when I look around the world, one of the regions I would advise investors stay away from is the Persian Gulf. So my first pan would be Market Vectors ETF that focuses on that region. And the ticker symbol for that is MES, and that stands for mess. In what may be an unpopular viewpoint right now, when I look at the fund's performance, it's only been up 2% per year, and with that kind of return, it's not worth all the risk. So this small, highly volatile fund with exposure in the wrong time and the wrong place, exposure to Dubai, is one that I would avoid. My second pan may also be a surprise. It's the ETF that focuses on Vietnam.
Okay, well, that's been a very popular market lately. In fact, Larry even mentioned that ETF earlier. Why do you feel that way?
Well, I don't want people to get it wrong. I believe that if you're a long-term investor, you'll do well in there. But I think that many of its neighbors will probably do better. Now, Vietnam, yes, will benefit from the growth and increased demand for commodities from China. But this ETF is primarily focused in financials and energy stocks. And neither one of those indices are really big exports for Vietnam. So unless you've really bought into the Vietnam growth story on a domestic basis, I would avoid this fund for now.
Okay, Rudy Martin, thanks for joining us.
Thank you.
We have talked a lot about the smaller emerging markets now, but coming up, it's time to turn our attention to the 800-pound gorilla in the room, that of course being China. As we've mentioned, it now dominates not only Southeast Asia, but many of the developing economies around the world. So what are the prospects for its continued economic growth, and what does that mean for investors here in the U.S.? Tony Sagami and Brian Rich will address those questions. And a final comment from Martin Weiss when Money and Markets returns.
Hi there, this is Mike Larson, editor of Weiss Research's Safe Money Report. You can't just focus on stocks anymore if you want to be a successful investor, and you can't just focus on the United States either. You need to know what's going on in Asia, which Tony covers. You need to know what's going on in hard assets like oil and gold, which Sean and Larry are on top of. You need to know what's happening in currencies, the specialty of Brian Rich. You also need to keep abreast of the best ways to build wealth in an era of near 0% interest rates. And that's what my colleague Nilis Mativ covers. And of course, you need the top-down, big-picture analysis that Safe Money delivers to you each and every month. Best of all, the Weiss Elite membership gives you access to all of that and more. The Weiss Elite gives you the tools and knowledge to profit from all of these market developments. Now, I may be biased, but I think it's a no-brainer. And I'm glad you're one of the smart investors who recognizes that fact. Thanks for your time.
Welcome back, everyone, to Money and Markets. The U.S. economy is still struggling, as evidenced by the recent GDP report showing 2.4% growth in the second quarter. Now, on the other side of the world, China is in the opposite situation. Its growth in the second quarter was over 10%. Now, that was down slightly from the first quarter, but it's still 5 times faster than the growth here in the U.S. Even if there is a moderate slowdown in China, what would that look like? Would it be a soft landing? And how can investors take advantage of it? Well, to help us answer those questions, let's bring back Tony Sagami. He's coming at us from Seattle, Washington. Tony, what would a soft landing look like for the Chinese economy?
Yeah, worst case, it would probably be 4 or 5% GDP growth, which is still double the growth we're seeing in the U.S. today. But I simply don't think that's going to happen. And even if it did, I don't think it would last very long. Look, the talk about a soft or a hard landing is really predicated on the assumption that a drop in demand from North America and Europe will take a toll on Chinese exports and hurt their economy. You know, you may see some effects from a slowdown in the U.S., but we're really not seeing that now. And tell you, I don't think we'll see much in the future either. You see, China's economy and most of Asia along with it is still humming along despite all the problems we've seen in the U.S. and in Europe. So I think it's really premature to be talking about a soft landing versus a hard landing. At this juncture, the Chinese economy is still flying and there's no landing at all.
Tony, what data are you specifically looking at to support that conclusion?
You know, I mentioned the international shipping data earlier. It tells me that not only is China doing healthy exports to other Asian countries, but it's also now importing goods from the rest of the world. Let me give you a perfect example. BMW recently reported fantastic profit numbers, but if you dig into those numbers a bit, and you know what you'll find? You'll find that sales growth in Europe was a pretty measly 3.6%. In North America, a little bit better at 5.6%, but in Asia, sales of luxury cars jumped by nearly 60%, and most of that growth came from China.
Okay, Tony, what about Chinese stocks? They haven't been doing very well at all over the past year.
That's precisely why it's such an opportunity. Its economy is flying, but the stocks haven't followed suit yet.
And why is that?
The key is that although there is some linkage between the stock markets of China and the West, we're starting to see more decoupling between the economies of China and the West. So whenever you see the China stock market decline temporarily in response to some other global problem, it's time to buy in anticipation of more domestic growth. Think of it as a gift. You know, here's the big picture. The Shanghai Composite Index has already seen a 30% correction. So there's not much more room for China stocks to fall. But if they do, it will be even a bigger gift for investors.
Tony, why do you think the slowdown in the rest of the world has not affected Asia as people had initially feared?
I think a big part of the reason is that the Asian economies are all helping each other. Think of it as the Asian version of NAFTA, except it's a successful one. China and its other Asian tiger neighbors, they're not putting up tariffs or walls between them. They're not erecting trade barriers. They're cooperating in every way they can. And boy, is it working, because they all seem to have things that the other countries need. Whether it's natural resources from India, Australia, or Indonesia, the cheap labor in China or Vietnam, or the capital that Japan has.
Okay, Tony, these Asian economies, they're all doing great, but the rest of the world is suffering. So how should investors play this?
There are all kinds of ways to invest in Asia. You can buy Asian companies on the highly liquid Hong Kong market, or even on the US exchange. If you don't want to buy individual stocks, there's a whole slew of ETFs that focus on different regions, countries, and market sectors. Or you can look for US companies that are deriving big revenues from Asia. Right now, the most successful American companies, the ones that are consistently delivering profits at or above expectations, are often the ones that are citing gigantic sales growth from Asia. You need to stock your portfolio with these type of companies, companies that make products that the Chinese are buying. And if you hold shares of companies that compete with China, get the heck out. A prime example is Dell. If I own stock, I would be quaking in my boots over competition from Lenovo. In a nutshell, as long as China's economy is cooking, you have to factor that in every stock purchase you make. And if it looks like it's starting to cool down, I will be the first to let you know ahead of time.
Okay, Tony Sagami out of Seattle, Washington. Thank you, Tony.
Thank you.
Another extremely important facet of the Chinese economy that American investors have to pay attention to is its currency market. Now, calls among U.S. lawmakers to force China to boost the yuan are as loud as ever before, and how China responds could have massive implications around the world. Joining us to help us break it all down and tell us what it means is Weiss Research currency specialist Brian Rich. Hello, Brian.
Hi, Jim.
Brian, first give us a little background here on what's happening with China's currency policy.
Sure. Well, a couple of months ago, China responded to those calls from U.S. lawmakers and the G20 to revalue the yuan. It depegged its currency from the dollar and began tracking it against the basket of currencies instead. But the yuan hasn't responded as the rest of the world had hoped. In fact, it's risen less than 1% against the dollar, far short of what the yuan should be worth.
Okay, but based on what, Brian?
Well, the fair value based on purchasing price parity. By that estimate, the yuan should be worth not 1%, not 10% more, but more like 40% more than where it's now valued against the dollar. China's not let that happen and won't let that happen, in my opinion. In fact, the meager rise of less than 1% so far is exactly what China intended. China's always done what's in its best interest, and it's in its best interest, frankly, to keep its currency far weaker than what it should be based on economic fundamentals.
As you well know, that obviously is what's keeping Chinese goods cheap right now, but why do you think that cheap Chinese goods are going to be such a threat to the global economy?
Right. It's never good for one country to have such a distinct and unfair advantage in global trade, but you've certainly heard that before. The point is, cheap yuan and cheap Chinese goods threaten economic recovery here in the United States and in Europe. The only way to achieve sustainable economic growth is by rebalancing the global economy. And without a a more fairly valued yuan, repairing global imbalances is highly unlikely. In fact, the current trade imbalances are a recipe for more destabilizing events, more booms and more busts.
Okay, so what kind of political ramifications then would we see down the road?
I think there's a good chance it could lead to protectionism, particularly here in the U.S. As you mentioned, we're already hearing calls for trade sanctions. If the U.S. economy doesn't turn around, there's a very real possibility trade barriers could become a reality. The problem with protectionism is that it tends to be contagious and it tends to bring about retaliation. During the Great Depression, there were widespread protectionist acts, and that brought global demand to a standstill.
Okay, Brian Rich, thanks so much for being here.
Sure.
The United States is still the world's biggest economy, but in talking with our guests this week, a common theme has emerged here. The U.S. and Europe are bogged down in debt and a long, drawn-out recession, losing control over their economy and their destiny. China and much of East Asia are in the catbird seat here, making decisions that are consistently in their best interest and still on a long-term growth path. This heralds new and exciting investment opportunities in markets that, frankly, most investors know very little about. This week, we've told you about some of those opportunities. Next week, we're going to look at more international markets that promise both value and growth in the coming years. One that is right on our doorstep. Young, commodity, exporting democracies like Canada, Australia, and Brazil are all poised for success, and we'll tell you how to take advantage of their new strength. If you want more information or have a suggestion for a topic that you'd like us to cover on Money and Markets, just email us at weissmoneynetwork@weissinc.com. I'm Jamie Holmes, and now, Martin Weiss.
Thank you, Jamie. Many decades ago, the Foundation for the Study of Cycles, which is a close partner to Weiss Research, made a startling forecast. The foundation said that by the end of the 20th century, we would see the beginning of a 500-year cycle, bringing a massive shift of wealth and power from the West to the East. Sure enough, that shift began in the late 20th century as China gradually shed the trappings of a socialist economy and began to grow by leaps and bounds. And now that shift is in full swing, both in good times and bad times. It's the fundamental force behind the growth in China, Singapore, and Malaysia. It is helping to drive a secondary growth wave in Brazil and in the CIVETS countries, Colombia, Indonesia, Vietnam, Egypt, Turkey, and South Africa. It's having a major impact. Does this mean that the East is decoupled from the West, or emerging markets are on a totally different track from developed nations? No. When markets sink or surge in New York or London, the same is likely to happen in Tokyo, Shanghai, or São Paulo, Brazil. So on a day-to-day basis, it might feel like there's no escape when markets are falling, or like there's no worry when they're rising. But such a narrow focus on short-term fluctuations can be very deceptive. If you step back from the trees and look at the markets or the economies from a broader perspective, you'll see an entirely different picture. Yes, both the West and the East are zigzagging, apparently in unison, but the West is zigzagging down, or at best sideways. The East is zigzagging up, and it's helping to pull other emerging markets up along with it. The pattern is clear. The down cycles in the West tend to be deeper and longer lasting. The up cycles in the East tend to be stronger and more sustained. And for investors, the strategy should also be clear. Intermediate economic recoveries and market rallies in the US or Europe should be viewed as opportunities to reduce your exposure, to build cash and liquidity, to batten down the hatches and prepare for the next storm. Conversely, intermediate declines in China, Brazil, and the CIVETS countries can be viewed as opportunities to get positioned or increase your stake. In sum, any future strength in the West will be time to sell. Any future weakness in the East will be time to buy. Thank you, and I hope to see you here next week, same place, same time.